The US dollar has been sold in the aftermath of the more dovish-leaning FOMC decision in which the Fed dropped its language of gradual tightening and a roughly balanced outlook, while highlighting a flexible approach to reducing the balance sheet in light of the current backdrop. In the post-2008 global financial markets crisis world, the mandate of the Fed has extended beyond the jurisdiction of U.S. borders and into the global economy, which has given the central bank its justification for hitting the brakes on the normalization process. The Fed hasn't had much room to be critical of the economic recovery in the U.S., at least as far as the metrics it values in making such a determination goes, which has left it citing uncertainties in the global outlook as the justification for the dovish shift on what it is called a common sense approach so that it can await greater clarity from upcoming data before issuing new guidance. Overall, there were definitely some dovish tweaks, but we don't believe these tweaks were all that surprising, and the wait-and-see tone is what we believe is the key takeaway. Yes, a little more dovish, but ultimately wait and see. We say this because we believe both the market and Fed need to be mindful of the risk of rising inflation in a world where such a jump would make things much more difficult for the Fed with respect to having the luxury of being overly accommodative. This is something that should not be forgotten in 2019 and a variable that could work its way into the mix sooner than later. But we do believe the FX market response is making sense, and there is room to price an even bigger adjustment to the Fed policy outlook, which is forcing yield differentials to reprice out of the dollar's favor. This also comes at a time when the world is waiting to see what comes of the talks between the U.S. and China on global trade. The U.S. administration has adopted a trade policy that promotes a softer dollar, and with the Fed also adjusting policy to the dovish side, we believe the buck continues to be exposed and vulnerable to setbacks in 2019. We see these setbacks more pronounced against the major currencies as risk-correlated FX will be less inclined to rally as much, with global equities expected to face headwinds in a world where central bank and government stimulus tools have been exhausted and investors no longer have that same immunity to downside risk as they once did. That's all for now.